Okay, and our final reading in the Level 1 syllabus is non-current, i.e. long-term liabilities. We're going to be looking at issuing bonds in this area. We'll be looking as well at leases, which is a big area and one that's very heavily examinable in the test, and also a little bit on pensions as well. Okay, our first LOS is determine the initial recognition and subsequent measure of bonds that have been issued by the company. Before we do that, let's have a little look at some terminology. Par value of the bond, of course, is the face value of a bond, normally quoted in $1,000 chunks in the US. It's the face value, and of course you get that bond back, or you get that amount back at maturity, regardless of whether you bought the bond at a premium or discount. At the end of the bond's life, you receive the par value. Coupon rate is often referred to as the stated rate, and it's the fixed percentage of the bond's par value that you receive as a coupon. Now again, remember in the exam, typically assume that coupons are paid semi-annually. The stated rate is always quoted as an annual percentage, whether the bond pays a coupon semi-annually or annually. Now, our initial liability. Our initial liability is going to be the issue price, i.e. the price that we get for our bond when we actually issue it. Up goes cash by this amount, and we record a liability at this amount. So notice it's going to be the present value of the future cash flows discounted at the market rate of interest when we actually issue the bond. Now our effective rate is going to be the discount rate that equates the present value of the bond's future cash flows with the issuance price, i.e. it's the market rate of issuance when the bond was issued. Now finally, our interest expense is the book value, so the opening value of our liability times each year times the effective interest rate. Now again, the key thing to note here that therefore the interest expense is not simply the coupon that you pay on the bonds that you've issued. So when we issue a bond, on our balance sheet we're going to create a liability equal to the proceeds received. In other words, up goes cash by the proceeds received, and we create a liability equal to the proceeds received. Then on our income statement, each period we're going to show an interest expense being the beginning of period book value, simply the opening liability value for our bond each period, times the market rate of interest when the bond was issued, i.e. that effective rate. Now what are we going to see in our cash flow statement? In our cash flow statement, of course, we're going to see the coupons that we pay out. So each period our CFO is going to be reduced by the coupon that we pay. Now of course CFF initially is increased by the proceeds we receive when we issue the bond, and then finally at the end of the bond's life CFF is going to be decreased as we pay out the principal, i.e. the par value of the bond. Now let's have a look at bonds that are issued at their face value. In other words, a bond will trade at par when you issue it if the market rate at the time of issuance equals the bond's coupon rate. So in the balance sheet, that means the liability is simply going to equal issuance price, which would be the bond's par value in this case. The liability is just going to sit there at face value, at par value over the bond, because there is no discount or premium, and as a result we don't require any amortization of discount or premium. It also means in our income statement that the interest expense, which would be opening liability times market rate at issuance, is exactly the same as coupon, because the market rate at issuance is the same as the coupon rate. Okay, so our interest expense would equal the coupon if a bond was issued at par value at initiation. However, of course, if bonds are not issued at par value, so let's talk about a bond that's issued at a discount. Well, why would it be issued at a discount? Because the market rate is greater than the coupon rate. In other words, investors require a return that is greater than the coupon. So how do they get a higher return than the coupon? They buy the bond at the discount, it redeems at par, and they get a capital gain. Now, of course, significance now is that the proceeds that you receive when you issue the bond are less than the bond's par value. So the liability is initially going to sit there at a discount to par. Now what we're going to find is that we're going to increase this liability over time because we're going to take this discount and we're going to amortize it, which means spread it over time. And two things are going to happen with this discount each period. We're going to amortize it, and as a result it's going to be added to the coupon in the income statement as interest. So the interest expense is going to be coupon plus the amortization of any discount. And also, the other side of that double entry, that amortized discount, will be added to the liability. So notice our book value, our balance sheet value, is equal to the present value of remaining cash flows discounted at the market rate at issuance. So initially our liability is just simply the cash value that we get. However, over the life of the bond, that discounted, the amortization of that discount is going to increase our liability. So with a bond issued at a discount, you'd expect the liability to grow over the bond's life until the liability sits there at par value when the bond is redeemed. Then, of course, when the bond is redeemed, we pay out the par value, $1,000, and eliminate the liability. There's no gain or no loss. Now, notice, therefore, that in our income statement, the interest expense is going to be the opening value of the liability times the market rate at issuance. Now, this has the effect, therefore, that the interest expense does not equal the coupon. In fact, the interest expense is coupon plus the amortized discount. And as we said, the interest expense is going to increase over time as slowly that liability increases over time until eventually it ends up at par value at maturity. Sounds complicated, but it's not going to be too terrible. Now let's look at bonds issued at a premium. Now, of course, if they're issued at a premium, the coupon is greater than the market rate. In other words, the coupon is higher than the investors require. So what we're going to need to do is give them a capital loss to bring down their returns. And we give them a capital loss by issuing the bond at a premium above par value. When it redeems, they only get par back, and that capital loss brings their returns down back to the market rate. Okay, so initially the liability is going to be greater than par value. Now what's going to happen this time is we're going to amortize the premium. And two things are going to happen with this premium. It's going to reduce the interest expense in our income statement, but it's also going to decrease the liability in our balance sheet. So what we're going to find here is the liability in our balance sheet decreases over time until at maturity the liability is sitting there at par value, and we redeem the bond, we pay out $1,000, eliminate the liability, and there's no gain, no loss. Okay. Income statement, our interest expense, therefore, is always going to be the opening liability times the market rate at issuance. This has the effect of giving us an interest expense that is equal to the coupon minus the amortization of the premium each period. Now, our interest expense is going to decrease over time because the liability in the balance sheet is going to decrease over time. Sounds quite complicated, doesn't it? But actually, when you see the numbers behind it, it's relatively straightforward. Now, there are two ways, essentially, of amortizing your discounts and premiums. Okay. One is known as the effective interest rate, and you have to use it under international accounting standards, but it is only preferred under US GAAP. Now, the effective interest rate essentially calculates your interest expense by looking at the yield to maturity at issuance times the opening liability. In other words, the yield to maturity at issuance, that's just the market rate when the bond is issued. So the interest expense each period is simply going to be the market rate times the opening liability. Now, the difference between the coupon that you pay and the interest expense in your income statement is the amortization of the premium or discount. And the other side of that amortization of premium or discount is it's added to your liability. So if you're amortizing a discount, it's going to be added to the liability, causing the liability to increase in the balance sheet. If you're amortizing a premium, it's going to reduce the liability. It's going to over time. Required under IFRS, only preferred under US GAAP. US GAAP gives us a cheaty kind of easier way of doing it as well. It allows us to use straight line amortization of premiums or discounts, where the annual amortization of the discount is simply going to be the total discount when the bond is issued, and that's the discount to par, divided by the number of years until the bond redeems. Likewise, for a premium, it would be the total premium above par when the bond is issued, divided by the number of years to maturity. So the interest expense each period would be that year's coupon plus the amortization of a discount, or minus the amortization of a premium. Notice that's permitted but not preferred under US GAAP. Okay, now we are asked to determine the initial recognition and then subsequent measures of the bonds, and we're going to need to do it, number one, using the effective interest rate method, and then using this nice straight line method allowed under US GAAP. So let's have a look then at our first one using an effective interest rate. Leeds Corporations issued a 3-year par value bond, $1,000 par value bond, with an annual coupon of 10% and it's issued at 951.96. So that's the proceeds that were received when it issued the bond. The market interest rate was 12%. So notice the coupon's 10, investors require 12%, which is why this bond trades at a discount when it is issued. So we're going to use the effective interest rate. So we receive 951.96, so up goes cash by 951.96, and we increase our liabilities by 951.96. So notice our initial liability when we first issue the bond is equal to the proceeds we receive, $951.96. Now, under the effective rate, we then take the market rate when the bond is issued, which is our 12% here, and we apply that to the opening liability. So if we do 951.96 times 12%, we get 114.24, and that is our interest expense in year one. Now let's compare that to the coupon. Note, of course, the coupon on this bond is 10%. It's always calculated, therefore, at 10% of par. We're assuming an annual pay bond just to make our life easy here. So the coupon, 10% of par, 10% of 1,000 is $100. So notice that the interest expense going through your income statement is bigger than the coupon. The difference is the amortization of our discount, which is $14.24. Now, two things happen to this amortization of the discount. It's added to the interest expense, which is why we show 114.24. The other side is it gets added to the liability. So the end of year one, beginning of year two, take your initial liability, 951.96, add on the amortization of the discount, so plus 14.24, and you'd have a liability sitting in your balance sheet at the end of year one, beginning of year two, of 966.20. So let's just talk through year two. In year two, you start with 966.20, you take the effective rate when the bond was issued, 12%, multiply it by 12%, and you get an interest expense of 115.94. Compare that to the coupon of 100, and you have amortization of your discount of 15.94. Again, that's added to the liability, so the liability at the end of year two, beginning of year three, is going to be 982.14. So let's take that final year, 982.14. Again, take the market rate when the bond was issued, 12%, and apply it to that. 12% of 982.14, you get 117.86. Compare that to the coupon paid, 100, and we've got amortization of our discount of 17.86. That gets added to your initial liability. So 982.14 plus 17.86 gives you a bond value at the end of year three of $1,000. Then, of course, the bond gets redeemed. All that happens is we reduce the liability by $1,000, reduce our cash by $1,000. So there's no impact on our income statement. Now notice, essentially, that the total interest expense, if we were to add this up very briefly, let me just quickly do that. If we add up the total interest expense, 114.24 plus 115.94 plus 117.86 gives us 348.04 compared to the total that goes to the cash flow statement of 300. The difference is 48.04, which of course is the discount to par that the bond was issued at. In other words, if you add up your total amortization of your discount, you get 48.04. So all we're doing is we're taking that discount that we issued the bond at and spreading it over the life of the bond through the income statement as if it was interest. Okay, so that's our essentially our first method really of doing it with effective interest. With straight line interest, we just take our discount, so $1,000 par value minus your 951.96. You say your total discount is 48.04, and you just divide that by 3, and you'd have a discount amortization of 16.01 for every year of the bond's life. Okay, now notice as well, when we do amortization of a discount, our interest expense in the income statement increases over the bond's life because the liability is growing each year. Okay, let's have a look then at that straight line. Notice what happens with straight line. All it means essentially is that the amortization of the discount is constant over its life at 16.01. We've had to do a little bit of rounding in year 3, which means the interest expense is constant in this case because it's just the coupon plus the amortization of the discount. Okay, so you get the same interest expense every single year. And again, what you'll notice, it will have an effect on your balance sheet liability because your balance sheet liability will be increasing by the same amount each year, the amortization of the discount. So in other words, at the end of year 1, beginning of year 2, it's gone up by 1601 to 967.97. End of year 2, beginning of year 3, it's gone up by 1601 again to 983.98. And at the end of year 3, it goes up by 1602 due to our little rounding, and it sits there at $1,000. Okay, so it's a very similar approach, but it just uses straight line amortization of the discount rather than effective. Allowed under US GAAP, not under international accounting standards. Now let's talk about a zero coupon bond. Now a zero coupon bond, of course, is just a deeply discounted bond because it has no coupon. Now, as it has no coupon, most people would say it would have no interest in your income statement. But they would be wrong. You are going to have an interest expense because you're going to spread that discount. Let's have a look at our example. Vine Corporation has issued a 3-year zero coupon bond here with a par value of $1,000 for 711.78. The market rate of interest when it was issued was 12%. So in other words, if we take our 1,000 minus what we issued it for, 711.78, actually there's a total discount of $288.22. And we're going to spread this over the life of the bond as if it was interest. Okay, so the bond is initially issued, up goes cash by 711.78, and we create our liability at 711.78. We then calculate our interest expense by taking the market rate when the bond was issued, 12%, times our initial liability, 711.78, and that gives us our interest in the first period, 85.41. Compare that to the coupon. Well, there is no coupon. That means the entire interest expense is just amortized discount. So that amortized discount gets added to the liability. So at the end of year 1, beginning of year 2, our liability is now 797.19. 12% of that gives us 95.66, which is the interest expense in our income statement in year 2. Okay, at the end of year 2, we add that amortized discount to the liability. So at the end of year 2, beginning of year 3, we now have a liability of 892.85. 12% of that gives us 107.14. Okay, and again, we've got a little rounding difference here, haven't we? 107.14. No coupon, so all of that's amortized. So add that to your opening liability, and you get a closing liability at the end of year 3 of $1,000, all ready for that bond to be redeemed. Down goes the cash by 1,000, eliminate the liability of 1,000, and there's no impact on your income statement. So notice, as long as we hold bonds to maturity, we have no gain or loss hitting the income statement when the bond matures. Let's have a look at our bonds that are issued at a premium. And again, first of all, let's have a look at the effective interest rate. So we've got a Liquid Corporation here, issued a $1,000 par value bond with a coupon of 20%. And it issued it at $1,130.88 because the market interest rate was only 14.33. So the coupon is bigger than the investor's required return, so the bond trades at a premium when it's issued. Now all we're going to do is take that premium and spread it over the life of the bond, and it will reduce our interest expense. So again, when we issue the bond, our cash goes up by $1,130.88, and we create a liability at $1,130.88. Our interest expense, we just take the market rate when the bond was issued, which in this case is 14.33. Okay, it's just the yield to maturity on the bond when it's issued, or the IRR, if you like, when it's issued. So if we take our opening liability of 1,130.88 and we take 14.33% of that, we get 162.06. So that is our interest expense. Now compare that to the coupon, 20% of par, that would be $200. So actually our interest expense is lower than the coupon because this period we have negative amortization because we're amortizing a premium. So that amortization of the premium has reduced our interest expense, and on the other side it's going to reduce our liability. So notice at the end of year 1, beginning of year 2, our liability is going to fall by $37.94 from $1,130.88 down to $1,092.94. The interest expense in year 2 is 14.33% of that year 2 opening liability, giving us 156.62. Compare that to the coupon, 200. This year we have amortization of negative 43.38. Again, that's reduced the interest expense. The other side is it's going to reduce our liability. So our liability falls at the end of year 2, beginning of year 3 by $43.38 down to $1,049.56. Okay. Year 3 comes around, 14.33% of that gives us an interest expense of 150.40. Compare that to the coupon of 200 and you get amortization of 49.60. Okay, again, that's added to the deducted from the liability, and the liability comes down to $1,000. No, it doesn't, you say, because there's a 4-cent rounding difference. Well, yeah, it's because actually that market interest rate wasn't 14.33, it was something like 14.33 recurring, okay? So we rounded slightly in our market interest rate. Otherwise, it would come down perfectly to 1,000. So again, notice that all that's happening with a bond issued at a premium is it's falling over time until at the end of the bond's life, it sits there at par value. That therefore has the effect that the interest expense is going to reduce over time as well. So liability falls and as a result interest expense falls. Now let's again compare that to the straight line amortization allowed by US GAAP. So here we are, straight line. Again, I'm just going to take my premium essentially here of $130.88 and spread it over 3 years, straight line. So 130.88 divided by 3. That means I'd have an amortization of each period of 43.63. So notice the interest expense is just the coupon minus the amortized premium each period. Okay, and notice therefore that the liability is just going down by the amortization of the premium each period. Excellent, so just be a little bit aware of that for US GAAP. Also we're asked to talk about issuance costs very briefly. International accounting standards, all you do is any costs relating to issuance, such as legal fees, commissions, underwriting, printing, etc. All you do is you deduct those costs from the bond's initial liability. Now, what that means is when you compute your market interest rate, because that's just the internal rate of return that looks at the discount factor that essentially equates price to the present value of future cash flows that you'll pay. Okay, so in other words, the market rate of issuance is just the discount rate that means the present value of the cash flows come back to the cash that you've received. Now, under IFRS, this price is reduced by the issuance costs, which means we must have a higher discount rate, a higher effective interest rate. So all that means under IFRS is you get a bigger effective interest rate, a bigger market interest rate that you apply to each year's liability. However, the initial liability is smaller because you've deducted the issuance cost from it. Under US GAAP, the treatment is different. Rather than showing deducting the issuance cost from the initial price and having a higher effective interest rate, the issuance cost is showed as a prepaid expense, essentially. Okay, a deferred charge, like a prepayment, so they sit in your current assets, really, or your non-current assets. Then what essentially you're going to do is amortize this prepaid expense over the life of the bond through the income statement. Now this is very controversial because you've got an asset sitting in your balance sheet even though it doesn't lead to any future economic benefits. So it doesn't really fulfill the classification of an asset. Remember, to show an asset, really we need to have a future flow of economic benefit. But it does mean under US GAAP that the liability figure initially will be bigger and the effective interest rate will be lower compared to IFRS. Right, okay, this is the world's most bizarre question, I have to say, but we'll have a look at it anyway. ACME issues an 8%, that's the coupon rate, 10-year annual pay bond when market yield is 7.5%. So no surprise, our bond trades at a premium. What is the impact on the bond on net income in the first year? Well, the impact, of course, will be market yield times proceeds, the initial liability. The initial liability will be equal to the proceeds we receive of 103,432. So, if we were to work out the interest expense, 103,432. Oops, can't write. 103,432 32, come on man, times 7.5% gives us 77.57. Okay, so we can get rid of A straight away. But it's not going to be A. Now it says, let's have a look at B. Minus 77.57, and net income is more than equal with proceeds from par debt. Now, initially when I looked at this, I thought if I issued a bond at par and the market yield was 7.5%, then essentially the interest would equal coupon, so it would be $75. And I went and saw the level 1 guy, Doug, who's in charge of all this, and he said, oh no, what I mean is you issue a par value bond with principal of 134.32, so it's equivalent to your premium bond. Okay, fair enough. In which case, if that was the principal on the par valued bond, 7.5% of that would be 77.57, and as a result, the answer would be C, your net income would be the same under both. Okay. Go figure. I don't think anyone would have got that by looking at the question. Right, okay. Next little LOS asks us to be a little aware. Let me get rid of that text ink from you there. There you are. There's your coupon of 77.57 each period. Okay, so yeah, it's only the true if this par value debt doesn't have a par value of $1,000. It has a par value equal to 103,432. Next LOS asks us to be aware of the effects of changing interest rates. Now, of course, we record our liability at the market value when the bond was initially issued, okay? And therefore, the effective interest rate is the market rate when the bond is issued. Now, once the bond starts to trade, of course, market rates are going to change. Yields in the market are going to change. And of course, we know there's an inverse relationship between debt and yields. As yields go up, bond prices fall. And as bond prices fall, yields go up. Okay, so there's an inverse relationship between market value and interest rates for bonds, as we know from fixed income. Or if we don't know it, we will do by the time we get to fixed income. Now, of course, once debt is issued, the firms initially report the book value of debt. The market value of debt is not reported in the balance sheet. Changes in the value of your bonds, simply because interest rates have fluctuated, does not affect the balance sheet or the income statement. Why? Because it's not the company's problem. The company was only interested in the market rate when the bond was issued because that affected their proceeds that they got. Subsequent fluctuations in market rates and bond prices, that's the investor's problem, not the company. So when interest rates start to change, it means the carrying value in the balance sheet will no longer equal the fair value of the bond. Now notice we've got one exception to this. If you hedge your liabilities using derivatives, the accounting rules under both US GAAP and IAS say both derivatives have to be marked to market, plus any asset or liability that they hedge have to be marked to market. So in which case, you would actually have to record the bond at fair value in the balance sheet if it was hedged by a derivative. If not, though, the carrying value will not equal fair value. So the idea, therefore, is when we look in our balance sheet, chances are the carrying value of the bonds that have been issued do not equal their fair values. Problem is, the analyst would rather like to see fair value rather than these book values, because the fair value, i.e. the market value of debt, would reflect the cost of the company of going into the marketplace, buying back its debt and cancelling it. So lower market values reflect stronger solvency positions because essentially you could buy back your debt more cheaply and cancel it. Now note, both IFRS and US GAAP do allow companies to choose to report debt at fair value rather than amortized cost. But it's an irrevocable, a one-way decision. Once you choose to report at fair value, you can't then go back to amortized cost. Okay, so just be aware that you can elect to report at fair value rather than amortized cost. Okay, our next little LOS asks us to be aware about debt extinguishment here. So when you buy back debt, now we saw from our earlier examples that if you buy back your debt at maturity, i.e. your debt redeems at maturity, because the balance sheet liability will always be par value $1,000, all that happens is you reduce cash by $1,000, you eliminate your liability $1,000. There is no impact on the income statement at all. So there is no gain or loss in the income statement if you repurchase at maturity. And in fact, that does mention it in this little side box down there. No gain or loss at maturity. However, if you buy back your debt prior to maturity, there can be a gain or loss. Why? Because the proceeds you pay to buy back your debt in the marketplace will represent the bond's fair value, its market value, which might not necessarily be the same as the bond's carrying value if you're holding it at amortized cost. So we do the following calculation to work out a gain or loss. We look at the carrying value in the balance sheet and compare it to the price you paid to repurchase that bond. If you've paid a greater price than carrying value, you're going to get a loss. If you paid a lower price to repurchase than carrying value, you're going to get a gain. And that is the gain, essentially, that we'd see under International Accounting Standards. So that is IAS. There's a further problem under US GAAP because remember, any issuance costs were held as essentially as an intangible prepaid asset. So any unamortized issuance costs would have to be eliminated, and those would reduce your gain or increase your loss under US GAAP. Okay. So we're going to see gains and losses hitting our income statement if the debt is repurchased prior to maturity. Okay, and it goes through our income statement within our continuing operations. Might be disclosed as an unusual or infrequent item if it's particularly large or particularly infrequent. Next, LOS, explain the role of covenants in protecting the lenders. Now, of course, the idea is a covenant is simply a restriction placed on the borrowing entity in order to protect the lender. Now, if you violate your covenants, you're deemed to be in technical default, and at the most extreme, the lender could demand repayment, or at very least, the lender is going to refinance and charge you a higher rate, so it's going to make your debt more costly in the future. Now, our basic forms of covenants fall into two types. Affirmative covenants, where essentially the borrower here is agreeing to do certain things, or negative covenants, where the borrower is agreeing that they won't do certain things. So let's have a look at some particular affirmative covenants, just so it's not an exclusive list by any means, but it gives you an idea. So in other words, the affirmative covenants may be that you make interest and principal payments on time. It may be that you maintain certain ratios, such as the current ratio, your solvency, interest coverage, EBIT over interest, etc. It may be that you maintain collateral if you've used assets to secure your bond. Now, of course, if you've used assets to secure a bond, then if you default on interest and principal, then that lender can put you into liquidation, sell off that asset and use it to recover their outstanding loan. So therefore, they'd be worried about the quality of that collateral. So if it's over things like land and buildings, they might make sure, therefore, that you maintain your land and buildings so that their market value, and hence the value of their collateral, doesn't fall. Now, negative covenants, you can see, typically restrict the borrower from doing certain things. And that could be, for example, paying dividends and repurchasing shares. Why? Because that reduces the cash available to pay off interest and principal. Engaging in mergers and acquisitions, because that could fundamentally affect the solvency and capital structure of the company. Issuing more debt, because again, in particular, they'd be worried about debt that ranks higher than them on a liquidation. So it might say, for example, in the covenants, you can only issue new debt that is subordinated to the existing debt, ranks lower on a liquidation. Okay, so those are our covenants. Discuss disclosure of long-term debt in the footnotes. So again, in the balance sheet, we know we're going to have to split our long-term debt between current liabilities, any bonds that were issued for the long term but now only have less than 12 months to maturity, and long-term liabilities, all those bonds falling due after more than 12 months. In the footnote, we're going to need to disclose the nature of the liabilities, i.e. the bond, okay, what it is, what its name is. We'll have to have the maturity dates, the stated rate, i.e. the coupon rate, the effective rate when the bond was issued will have to be in there. If there are any call features or conversion privileges, a call feature allows the company to call the bond back, buy the bond back, normally at a premium to par prior to maturity. Conversion privileges, of course, allow the bond to be converted into equity. Any restrictions imposed by the creditors, i.e. covenants particularly, would have to be disclosed. Any assets that have been pledged by security on the loans, And then finally, and this one is a key one for the analyst, the amount of debt maturing in each of the next 5 years. Of course, this is very significant because we now know what we're going to have to pay off in the next 5 years, and we can use that to assess the solvency. Do we think the cash flows from operations that they're generating are going to be sufficient to pay off the debt in each of the next 5 years? Okay, now we move our attention from bonds into leasing, so leasing assets. Our first LOS asks us to discuss the motivations behind leasing assets. So why lease an asset rather than borrowing money and purchasing? Number one, short period of use. So maybe you don't want to use the asset for its entire life. Well, this is good. If you lease the asset, at the end of the lease period, it returns to the lessor. Cheap financing. You might find that it's cheaper to lease an asset rather than going out and borrowing the asset. You might find it's cheaper to lease the asset than going out and issuing debt and using that debt to purchase the asset. So the rate implicit in the lease may be lower than your incremental borrowing rate. No down payment. Typically, we don't have to pay anything up front under a lease, unlike purchasing an asset. Also, a lease locks us into a fixed interest rate over its life. So it may be attractive if you can only borrow at floating rates. You might not want to borrow at a floating rate and purchase an asset because then you've got interest rate risk. You might find that leases have fewer covenants than actually issuing bonds and using the finance to purchase assets. Less risk of obsolescence of the asset because at the end of the day it's not your asset and it's going to return from the leasee to the lessor at the end of the asset's life. So it's the lessor's problem about obsolescence rather than the leasee. Leasee is the person that's essentially renting the asset. Lessor is the person that owns the asset and rents it out. Potential financial reporting advantages with operating leases. Well, we're going to see these in a second. We tend to refer to our operating leases as being off-balance sheet finance because there's no recognition of an asset in our accounts. There's no recognition of a liability, even though we have the obligation to make future lease payments. Okay, that's only operating leases. And also under US GAAP, there can be some tax advantages with synthetic leases. A synthetic lease would just allow you to report an asset and a liability in your balance sheet, and you're allowed to deduct depreciation on the asset even though you don't legally own the asset. Next LOS, and this is a biggie, distinguish between capital and operating leases. Now, capital leases also get called finance leases. They tend to get called finance leases under international accounting standards and more commonly capital leases under US GAAP. So we're comparing finance stroke capital lease to an operating lease. Now, we need to know when will it be treated as a capital lease. US GAAP has a rule, a set of 4 rules, and it's if any of these are met, okay? Any, not all of them, just any. Number 1, title to the lease asset transfers from the lessee, transfers to the lessee from the lessor at the end of the lease. Now, we would typically refer to this as hire purchase in the UK. So you make your lease payments, and at the end, when you make your final lease payment, you become the owner of the asset. Okay. Number 2, a bargain purchase option exists. So at the end of the lease, you have the right to buy the asset below its fair market value. Now, 3 and 4 are the ones that get tested most often in the exam. Number 3, you're leasing the asset for 75% or more of its economic life. Or number 4, the present value of the lease payments. So you look at the terms, the number of payments you're going to make under your lease, discount them back, and if they're greater or equal to 90% of the leased asset's fair value, i.e. its market value, again, it's going to be a capital lease. IFRS doesn't have those 4 rules. However, IFRS is currently in a state where they're reviewing this, and as a result, I wouldn't be at all surprised to see these harmonized in the future. But IFRS says it's a finance lease if substantially all the rights and risks of ownership transfer from the lessor to the lessee. Okay, now, what about the accounting treatment of a finance lease? The accounting treatment of a finance lease completely differs from an operating lease. With an operating lease, remember, there's no balance sheet recognition of an asset, there's no balance sheet recognition of a liability. However, with a finance lease, stroke capital lease, what we're going to try and do here is give the illusion in our accounts as if we'd purchased an asset and we'd used debt to finance it. So we're going to record an asset and we're going to record a liability. Now, essentially, we're going to record the asset and liability at the present value of future lease payments. Well, it's actually the lower of fair value or present value of future lease payments, essentially. Typically, it's recorded at the present value of future lease payments. And we record that as an asset and a liability in our financial statements. The asset is going to be depreciated over time, so the asset value will fall. Its salvage value is 0, remember, because you don't own the asset. That belongs to the lessor. It will go back to them. So even though you've got the asset in the balance sheet, you don't necessarily own it. You're going to depreciate that asset over time, and that will have an impact on the income statement. In the liability, again, we record a liability equal to the present value of the lease payments, and that, again, is going to be shown as a liability, split between current and long-term liabilities. We're actually going to charge interest on the liability over its life. So in our income statement, we're going to see depreciation and interest. In our balance sheet, we're going to see an asset and liability. The asset and liability are equal to one another at initiation of the lease, but after that they don't have to be, because the depreciation on the asset is its own double entry. The interest and payment of the principal on the liability are their own double entry. So the asset does not equal the liability after initiation. Now, every time we make a payment on our lease, it's going to be treated like amortizing debt. So every time we make a payment on the lease, part of that is paying off interest, the remainder is paying off principal. So the liability is going to fall each period as we make principal payments. Okay, let's have a little look at our example here. So we've got a firm leasing an asset for 3 years. Payments are $10,000 per year. And we've got straight line depreciation with 0 salvage value. We've got the fair market value of the asset is $27,000. And we've got a rate implicit in our lease of 7%. Okay, let's just discount those future payments. So let's discount the payments. IY, our discount rate is going to be 7. N, the number of payments, is 3. And payment is 10,000. And we're assuming we're making 10,000 at the payments at the end of each year here. So when we do that, 3 is N, 7 is IY, 10,000 is payment, compute present value, you get 26,243. Now compare that to the fair market value of the asset. The actual asset, if you'd gone out and bought it, cost 27,000, and we use the lower of the two figures, so we're going to record the asset and the liability at 26,243. So our asset's going to be recorded at the present value of lease payments. The liability is going to be recorded at the present value of lease payments, so 26,243. Now, the asset's going to be depreciated over time. The liability, we're going to have interest and principal payments. So let's have a look at our liability. So there you go. There's our liability at the beginning of year 1, recorded at 26,243. We then charge interest on that liability by taking the opening liability, 26,243, and using the discount rate used to calculate it, which was 7%, and that gives us 1,837. We've then got a payment at the end of the year of 10,000. And what we're going to argue is, of this payment, 1,837 relates to interest, so the balancing figure, essentially, 10,000 minus 1,837, 8,163 is paying off principal. So the interest element's going to hit our income statement, giving us a bigger interest. The principal payment of 8,163 is going to reduce your liability in the balance sheet. So our liability in the balance sheet is going to fall by 8,163, so 26,243 minus 8,163, our liability at the end of the year is 18,080. Don't worry about the book value of the asset yet, I'll come back to that in a second. So beginning of year 2, the liability is sitting at 18,080. 7% of that gives you your interest, 1,266. You then pay your payment, your rental payment. 1,266 is paying off interest. So 10,000 minus 1,266, 8,734 is paying off principal. So therefore the liability falls from $18,080, it decreases by $8,734 down to $9,346. Okay, opening value of the liability at the beginning of the third year, 9,346. 7% of that gives you 654. You then pay off your final payment. 654 of that is paying off interest. So the balance, of course, is paying off your liability. So 10,000 minus 654, 9,346. So when you make your final payment, your liability falls to 0. So your principal payments each year are simply the payments minus the interest expense for that year. Now, of course, as well, we've got the asset that we're sitting there at 26,243 each period, and that's going to be depreciated straight line. So 26,243 divided by 3, no salvage value because you don't own the asset. Our depreciation is 8,748 per year. So at the end of the first year, cost 26,243 minus 1 year's of depreciation, 8,748. The value falls in your plant, property and equipment to 17,495. You'll notice, therefore, that, as I said earlier, there's no reason why the asset has to equal the liability once the lease starts to trade. Now, when the asset and liability were first created, yes, they equaled each other. But after that, no, they're not necessarily going to equal one another. So in year 2, 2 lots of depreciation charged, so 2 lots of 8,748. So the net book value falls to 8,747. And then, of course, at the end of the asset's life, its net book value falls down to 0. Also, one other thing just to point out, we'll never actually see a liability sitting all in one place for 26,243. Why? Because that liability has to be split between current liabilities and long-term liabilities. So in fact, of that 26,243, the principal payment in year 1, 8,163, that will be sitting in current liabilities. Principal payments after more than 1 year, 18,080, that will be sitting in long-term liabilities. So just be aware that your liability value has got to be split between current and long-term liabilities each period. Okay, so in year 2 you won't see the 18,080. You'll see 8,734 in current liabilities. You'll see 9,346 in long-term liabilities. Okay. Let's talk about cash flows as well. Now, what's going to happen on our cash flow statement? Each time, of course, each year we make a payment of 10,000, so our cash goes down by 10,000. However, under a finance lease, we've got to split that 10,000 between interest, which will go through our CFO, and principal, which will go through our CFF, cash flow from financing, as if we were paying off debt. Okay, so just note, therefore, you can see that the interest declines each year as the liability gets paid off, and as a result, the principal, and hence the amounts going through your CFF, will increase each period. Now, compare that to an operating lease. Under an operating lease, every time you make a payment, down goes cash by 10,000, and it all goes through cash flow from operations. Okay, so there's no split of interest and principal. In fact, the accounting treatment, every time you make a payment under an operating lease, down goes cash by 10,000, and a rental expense would appear in the income statement of 10,000 in your sales, general and admin, if it was to do with your day-to-day running of the business. If it was leasing an asset to do with the production of your goods, it would go through your cost of goods sales. Okay, so just be aware the full 10,000 is taken through CFO under an operating lease. So what is the total impact of finance leases versus operating leases in the income statement? Well, under a finance lease, what we see in the income statement is the interest on the liability and the depreciation of the asset. Under an operating lease, we just see the rental expense of 10,000 each year. Now, what we're going to tend to find is that interest and depreciation are greater than the rental expense in the earlier years, so net income is going to be lower for a finance lease compared to an operating lease in the earlier years. But because the interest expense reduces over its life, interest plus depreciation will be smaller than the rental expense in later years, so net income would be higher for later years. Okay, also notice your CFO is always going to be higher for a finance lease because only interest goes through CFO, whereas CFF is going to be lower for a finance lease because the principal payment goes through CFF. Good. Let's compare our income statement effects. I've set it out for our capital lease for our previous example. So you can see under our capital lease, of course, we have our interest expense each year. 1837 for year 1, 1266 for year 2, 654 for year 3. And we have our depreciation each year. There we go. Add the interest and depreciation and we get our total expense. 10,585 in year 1, 10,014 in year 2, and 9,401 in year 3. Now compare that to the operating lease. Under the operating lease, you would have had a 10,000 rental expense every year. Okay, remember the only double entry is down goes cash, record a rental expense in the income statement. So notice, if we look at the first year, the total amount in your income statement is higher under the finance lease compared to the operating lease, so you have lower net income. But if you look at the later year, the reverse is true. You've got less expense in your income statement under the finance lease and more under the operating lease. Again, it's worth pointing out as well, if you look at the total amount of interest and depreciation, add those together, you get 30,000. Total amount that goes through the income statement under the operating lease, also 30,000. So the total amount of expenditure that goes through our income expense, so it goes through our income statement, I should say, is the same under an operating lease and a finance lease over the asset's life. It's just that we have more expense in the earlier years for the finance lease and less expense in the later years. Okay, let's think about how that's likely, therefore, to affect our accounts. So you can see earlier years, higher expense for a finance lease, okay, giving us lower net income. Later years, of course, you can see lower expense and then it's higher net income with the finance lease. Overall, though, the same total. Okay, let's have a look at the impact on our financial statements. Finance compared to operating lease. Remember, operating lease, no recognition of asset, no recognition of liability. So therefore, assets and liabilities under an operating lease will be lower compared to a finance lease. Well, we do have the recognition of an asset, we do have the recognition of a liability. As we saw on the previous slide, our net income for a finance lease is lower in the earlier years because the sum of the depreciation and interest is greater than the rental expense. So net income is lower with the finance lease in the earlier years compared to the operating lease, but higher in the later years as the interest gets smaller and smaller as the liability is paid off. Total impact on net income, well, we saw 30,000 went through under a finance lease, 30,000 went through under an operating lease, so over the life of the asset, the same amount will go through your net income. Cash flow from operations is going to be higher under a finance lease because only interest goes through CFO, whereas under an operating lease, the full rental payment goes through CFO, giving a lower figure. Cash flow from financing, of course, the principal payment under a finance lease goes through for cash flow from financing, giving you a lower figure, whereas under an operating lease, nothing goes through cash flow from financing, so comparatively you have a higher figure. Total cash flows should be the same, the 10,000 that you pay each and every year. Okay, let's have a look at a little question then, a little leases problem. Acme reports its lease of equipment as an operating lease rather than a capital lease. The effect in the first year would be to, well, if you have an operating lease, you're going to have higher net income. Okay, now that rules out therefore C, so we can get rid of that one. If you have an operating lease, everything goes through CFO, of course, so you're going to get a lower CFO. So if you have it as an operating lease, you're going to have higher net income, but a lower CFO. So our answer should be, okay, what the heck? Acme, let me read the question. Acme reports that its lease of equipment as an operating lease rather than as a capital lease. The effect in the first year would be to decrease net income as an operating lease rather than a capital lease. Let me think. This doesn't seem right to me. If you treat it as an operating lease rather than a capital lease, you would have higher net income, not lower net income. So I disagree with that. But if you did, I think this is really looking at the other way around, treating it as a capital lease rather than an operating lease. Remember, with an operating lease, you have higher net income in the earlier years, but you have lower CFO because your full rental payment goes through CFO. So I don't agree with that unless I'm reading the question wrong in some bizarre way. Let me read it one more time. If Acme reports its lease as an operating lease rather than a capital lease, the effect in the first year. Operating lease, you would definitely have higher net income. So I'm sorry, I just don't agree. C, I think actually the answer should be A. Okay, so I'm going to disagree with that one. You can write into Swayze if you can think of some reason why I'm wrong. Good. Okay, now, there we go. That's a tough old reading. Leases are just so incredibly popular in the exam. You really, 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 really must make sure you are all over them before you go into that exam hall. Right, okay, so there we go. Leaseor financial reporting. We're now looking at. We've been looking at leasee. What happens to the person who rents the asset? What about the person who owns the asset? Well, again, it's going to rather depend on whether they have a lease it out as an operating lease or a financing lease. If they treat it as an operating lease, they will keep the leased asset in their balance sheet. All that will happen is they will receive rental payments in, and that will be shown as rental income in their income statement, increasing their net income. And of course they will have, it will also increase the cash in their balance sheet as they receive payments, of course. And they will depreciate the asset in their balance sheet. Okay, so that will go through the balance sheet and the income statement. So in other words, they keep the balance sheet, the asset in their balance sheet if it's treated as an operating lease. If it's a finance lease, the treatment is going to be rather different. And in fact, there are two different types of finance lease, which we'll talk about in a second. Under a finance lease, the leaseor is going to report the lease receivable on their balance sheet, i.e. the amounts that they're owed under the terms of the lease. Well, actually, it's the present value of the amounts that they're owed under the terms of the lease, and they're going to record that as an asset. They're going to recognize lease payments as part interest, okay, and part return of capital. So their asset's going to decline by the capital payment each period. Now, there are two treatments of finance lease. Either you can treat them as sales type leases or direct financing leases. Let's talk about those. Okay, so with a sales type lease, the sales type lease, you tend to be a manufacturer or dealer of the leased equipment. All that's happening is you're leasing the asset out to your customer rather than selling it to them. So what you tend to find is the present value of the lease payments is greater than the carrying value of the leased asset, because it's as if you'd sold it. All you're doing is providing them with finance. It's like you're giving them a loan in order to purchase the asset, okay? And you'd only ever sell an asset above its carrying value. So present value of the lease payments is going to be greater than carrying value, and therefore we deem it to be a sales type lease under US GAAP. What this allows you to do is at inception, the leaseor is going to recognize a gross profit. If you treat it as a sales type lease, the asset is removed from their balance sheet as if they disposed of the asset. So what you're going to do is you're going to show sales that are equal to the present value of the lease payments you've received, and compare that to the cost of goods sold for the disposed asset, which will be the carrying value of the asset. In other words, you're going to recognize a profit up front. So some of the payments are going to, some of the profit is recognized up front. The rest of the profit on the lease is going to be spread as if it was interest over the life of the lease. Okay. So notice any difference between interest revenue and payment reduces the lease receivable, reduces your balance sheet asset, and of course the payment goes through CFI. Excellent. Okay. Let's talk about a direct financing lease. So here you do not manufacture or sell this particular leased equipment. You're a pure finance company. All that's happened is a company's come to you and said, would you mind going out and buying this asset on my behalf and then leasing it to me? As a result, the present value of the lease payments should equal the carrying value of the leased asset for the leasor, because all they're trying to do is make interest returns, as if they've essentially as if they've made you a loan. So no gross profit is recognized at the inception of the lease because the sales proceeds are equal to the cost of the asset. So there's no gain, no loss at inception of the lease. Instead, all of the profit is going to be recognized as interest revenue over the term of the lease. Again, the difference between interest revenue, which will go through CFO, and lease payments, which will go through CFI, principal payments, reduces the lease receivables in your balance sheet. So the asset should fall over time. Let's have a quick look at a direct financing lease example. So Rowlands Incorporated leases a machine to Hall Company. The lease qualifies as a finance lease. The terms of the lease are 3 years at $10,000 per annum. Rowlands estimates the machine can be sold in 3 years for $5,000 and the asset cost $24,000 to purchase. So first of all, we're going to work out the rate implicit in the lease, which is just an internal rate of return calculation. So number of years, 3. We're going to receive payments of 10,000 each year, payment. Future value would just be the salvage value. Remember, the asset will return to the leaseor at the end, so you do include salvage value. And the present value is 24,000, the cost of going out and buying that asset. So let's put that in present value, and we compute IY, and we get 19.897%. So essentially that is the effective rate implicit in the lease. So we're now going to show, notice we're going to show the beginning lease receivable equal to the price we paid to acquire the asset. Well, again, remember the price we paid to acquire the asset is the present value of the minimum lease payment, so it would be 24,000. That, of course, is an asset. We're then going to show interest income by taking our rate implicit in the lease, which was our 19.89%, and applying that to the opening asset. So 24,000 times 19 point whatever it was, 897%, gives us our interest income of 4,755. We've then got a payment, okay. So we've got a payment of 10,000. Now, what we're going to argue is that 10,000 payment pays our interest, 4,775. So that will go through CFO, increasing CFO by 4,775. The other element is paying off our asset, essentially reducing our asset, and that will go through CFI. So essentially, we'll have 5,225 going through CFI. Okay, and of course, as well as that 5,255 going through CFI, the asset will fall from 24,000 in our balance sheet by 5,225 to 18,775. Year 2 comes around, 18,775. We take our rate, 19.897%, apply it to the opening asset to get our interest income of 3,736, which of course is going to go through the income statement. We then got a payment of 10,000. The balance, so of that 10,000, 3,736 represents interest received. The balance is of course paying off your asset, so the asset in the balance sheet falls by 6,264 down to 12,511. Of course, again, in terms of our cash flow, the interest received goes through CFO. The reduction in the lease receivable is as if we're losing an asset, so essentially it goes through CFI, increases our CFI. And this happens throughout the life of the lease. So let's look at year 3. Our opening asset is now 12,551. 19.897% of that is 2,489. Payment of 10,000. Okay, of that means our asset falls by 7,551. So you can see that our asset at the end of the lease is sitting there at 5,000, which we think is the salvage value. Okay. Notice the interest income, part of the payment goes through CFO. The reduction in the lease receivable, the reduction in the asset goes through CFI. Okay. Unless you're a leasing company, in which case it goes through CFO. Good. Lease disclosure. We're getting there, you'll be pleased to know. Lease disclosure now. Our lease disclosure, it says compare and contrast disclosure for finance and operating leases. Well, they're relatively similar, the disclosure. So number 1, a general description of the leasing arrangement, the asset leased, the terms of the lease, etc. Then, of course, the nature, the timing, and the payments to be paid or received in each of the next 5 years. Okay, so each of the next 5 years, and then aggregated beyond 5 years. Now that's true of US GAAP. Unfortunately, under IFRS, they actually only have to show aggregated amounts under 5 years as well. So in other words, the payments under the terms of the lease for the next 5 years, and then aggregate payments after more than 5 years. We also need to show lease revenue and expense for each period presented in the income statement. So what's gone through the income statement? Amounts receivable and unearned revenues from leases would have to be shown as well. And again, that's going to be for leaseors, not leasees. And then also any restrictions imposed by the lease arrangements. The only other difference is for finance leases, you have to show the present value of the minimum lease payments in your footnotes, and the difference between the future value of them, i.e. the undiscounted amounts, and the present value of them. Whereas under operating leases, you don't have to show the present value of them. Excellent. Okay. Oh, we've got a lease problem coming up. I'm now scared of these lease problems after the last one. Under IFRS, a leaseor would be most likely to recognise a depreciation expense related to a leased asset for a lease classified as. Okay, so when would we have depreciation? Well, the only time we'd have depreciation is if it's an operating lease, because that's the only time we keep the asset in our balance sheet. With financing leases and sales type leases, we treat the asset as being disposed. It's just that there's no profit on a finance lease because the sales proceeds equal the cost of the asset, whereas under a sales type lease, the sales proceeds, the present value of the future payments, is greater than the cost of the asset, so you have a profit up front. Hooray! Right, little bit on pensions. It says describe our two types of pension, defined contribution and defined benefit. So what is a defined contribution? Defined contribution, nice and straightforward. All that's happening here is your employer agrees to contribute a fixed percentage of your salary into a pension plan each year. So for example, I've got a defined contribution plan where Kaplan agrees to pay in 5% of my salary into my pension plan each year. Okay. Now, they're not guaranteeing what that will pay for when I retire. That's my problem, okay? So there's no guarantee of benefits. All they're guaranteeing to do is pay in that fixed percentage of my salary for each year that I work at the company. So I've got all of the investment risk. Essentially, if the portfolio is worth very little because the market's crashed when I retire, tough luck me. But the accounting is dead straightforward. All that happens is every time that they make a contribution in your plan, that contribution goes through the income statement as a pension expense. Okay, the other side, of course, is it reduces cash in their balance sheet. You're not going to see an asset or liability. Well, I guess you could have a liability if they're due to pay in your plan at year end but haven't yet done so. Then the liability would be that year's contribution that they've yet to pay. Okay, asset, well, I guess you could have if they've overpaid. Now, defined benefit. These are the problem ones for us as an analyst. Defined benefit, your employer is promising to pay a specific stream of cash flows to you when you retire. And those stream of cash flows is normally based on your final salary and how many years you've worked to date. In fact, it's normally three things. It's based on your age at retirement, it's based on your final salary, and it's based on the number of years worked. Now, because they're agreeing to make specific payments to you, they have the investment risk. They need to make sure that they have a pool of assets that is sufficient to generate these cash flows to you when you retire. Now, the accounting is quite frankly horrific. Now, you'll be quite pleased to know that whilst it's horrific, most of it's sitting in the level 2 CFA exam rather than the level 1 exam. So we just need to know it's horrific really for level 1. It's very complicated. Why? Because the employer needs to estimate the liability. In order to estimate the liability, they need to estimate what your final salary will be, estimate then for how long you'll live for as well, and estimate a discount rate so they can work out the present value of the payments that they make to you based on your final salary. So it's quite complicated. We tend to call it the PBO, the Projected Benefit Obligation under US GAAP. And it's affected by your compensation growth, when you'll retire, how long you'll live, and the discount rate used to discount those future cash flows back to today's date. Okay, so we call it, PBO is the name for it, the liability under US GAAP. Defined benefit obligation, same thing, is what they call it under international accounting standards. Now, what goes through the income statement? What goes through the income statement, again, is going to be quite complicated. What goes through the income statement is service cost. Now, service cost is simply the present value of the benefits that you've earned during the current period. Because you've worked for one extra year, you're entitled to more benefits when you retire. So the service cost is actually the present value of the benefits that you've earned during the year, but it's actually based on your final salary. Now, interest cost, that is the increase in the pension liability to the company due to the passage of time. Remember, we said the pension liability to the company is the present value of the payments they'll make to you on your retirement based on your final salary. Now, of course, every year we move, we're 1 year closer to retirement, so they're discounting those benefits back one less year, and if they're discounting back one fewer periods, then the present value, of course, increases. So the interest cost is simply the increase in the liability, the PBO or the defined benefit obligation, simply due to the passage of time. Now we take service costs plus interest costs, which are referred to as the actual expenses, and we then deduct the expected return on plan assets. Now all this is the long run expected return that your actuaries believe that you'll be able to generate on the portfolio of assets that you're using to fund your liability. It's the expected return rather than the actual return to allow us to smooth for volatility, essentially in the marketplace. If you put actual return on plan assets, then the pension expense would have the same volatility as the stock market, and we don't want that, so we're allowed to smooth. Now we're also going to see the amortization of actuarial gains, which will reduce the pension expense, and the amortization of actuarial losses, which will increase the pension expense. Now when changes in actuarial assumptions, and actuarial assumptions are anything that affects the pension liability, so they're things like their expected rate of final salary for them, the discount rates that they're using to calculate the PBO, the expected life expectancy of the employees. So if the actuaries change their assumptions, that's going to increase the PBO or decrease the PBO. If it increases the PBO, we call it an actuarial loss. If it decreases the PBO, we call it an actuarial gain. Now there's another source of actuarial gains and losses as well, and that's the difference between the expected return on plan assets that's gone through the pension expense and the actual return on plan assets. If the expected return is greater than the actual return, you have an actuarial loss, and if the expected return is smaller than the actual return, you have an actuarial gain. So they look at all these sources of actuarial gains and losses, and if they're particularly large, and we'll look at what it means to be particularly large at level 2, they have to be amortized, which means they're spread over the remaining service life of the employees. Okay, so it seems a little bit weird, these actuarial gains and losses being amortized. It says the reason for this is it reduces volatility. Okay, so rather than putting the full actuarial gain or loss through the income statement when it's incurred, giving you a very volatile pension expense, instead we're going to hold these actuarial gains and losses largely off balance sheet and amortize them instead through the income statement, which is spreading their cost over the remaining service life of your employees, which reduces volatility. Also, we're going to have past service costs. Now, past service costs are retroactive benefits awarded to employees. Now, essentially, if we increase the benefits you're entitled to on retirement, that increases the PBO, the liability. Okay, so that's a loss. If we decrease the benefits you're entitled to, that would reduce the PBO, which would be a gain. Now, again, under US GAAP, these prior service costs are held off balance sheet essentially and amortized through the income statement. Under international accounting standards, they have to be expensed in the year that they're incurred. However, when you look at the CFA Institute's material, it doesn't mention past service costs having to be expensed when they're incurred under IAS. So just be aware, therefore, that you can amortize them. Although, rather bizarrely, it does say that. It says you have to expense them immediately under IAS under level 2, in level 2. So there you go. Okay, the important point, though, is our pension expense is a smooth number because we're using the expected return on plan assets, and we're allowed to amortize slowly over the remaining service life of our employees actuarial gains and losses and prior service costs rather than expensing them immediately when they're incurred. Okay, balance sheet reporting. Big differences between US GAAP and international accounting standards. Now we know defined benefit obligation, that's the International Accounting Standards term. That is simply the present value of the benefits you're going to pay to your employees based on their final salaries discounted back to today. Under US GAAP it's called the PBO, the projected benefit obligation. Same thing. Present value of benefits earned to date based on their current working history. Now, if we take the fair value of the plan assets, the market value of the plan assets, and subtract the liability, the defined benefit obligation, we get funded status, which is the economic position of the plan. Now, under US GAAP, the economic position of the plan is reported on the balance sheet. Okay, so if the plan assets are bigger than the liability, you're going to have an asset equal to funded status. If the plan liability is bigger than the plan assets, you're going to have a liability equal to the underfunded status. IFRS, rather confusingly, we don't see funded status as our asset or liability. And it's due to those smoothed items that we saw in the income statement. The unamortized actuarial gains and losses and past service costs are not included in the balance sheet asset or liability. They are in funded status, but they're not in the balance sheet asset or liability. So US GAAP brings them into the balance sheet. IFRS excludes them from the balance sheet, which means the asset or liability in the balance sheet is not funded status. It is not the true economic position of the pension plan. Okay, now you'll be pleased to know that's all you need to know at level 1. We're going to come back to this at level 2 and look at the detailed accounting, which is going to cause us some headaches, I can tell you that. Our last little LOS for this reading is to be able to calculate solvency ratios, which is quite nice because we've talked about all of these already. We've got our leverage ratios, which of course have a balance sheet focus. They tend to look at debt compared to equity or debt compared to assets. They're looking at the firm's capital structure. And we also look at our coverage ratios, which is really looking at our ability to pay interest and principal on time. Our classic coverage ratio is the interest coverage ratio, EBIT over interest, of course. So let's have a look at some of our ratios. Total debt, just remember when they refer to total debt, they mean all long-term liabilities and any short-term interest-bearing liabilities. So short-term interest-bearing liabilities, but all long-term liabilities. Okay, so things like deferred tax, providing it's going to reverse, would be included. So debt to total assets is total debt divided by total assets. Debt to capital, of course, is total debt over total debt plus equity. And debt to total capital, therefore, is showing you the proportion of your capital structure that is funded by debt. Okay, what proportion of your capital structure, percentage-wise, is financed by debt? Debt to equity is just a ratio, of course, of total debt over total equity. So in other words, it just must be 1 plus the debt to capital ratio. So total debt over stockholders' equity. Financial leverage ratio, which is of course a key component of the DuPont analysis, is average total assets on the numerator, average total equity on the denominator. Again, the argument is if you are financing your purchases of assets using primarily equity, this ratio should be close to 1. As soon as you start to finance your asset purchases using debt, average total assets is going to rise, but equity isn't, so the ratio starts to climb above 1. Interest coverage, our classic interest coverage, is EBIT, operating profit divided by interest payments. Remember the fixed charge coverage says, oh, what about lease payments as well? All of our fixed costs. So it takes EBIT and adds back lease payments on the numerator, and it takes interest and adds lease payments to them on the denominator. Fantastic. Okay, and we are done. Congratulations, you made it to the end of financial reporting analysis. Remember, ratios are critical for the exam. It's a tough area of financial reporting analysis. It's not one of the most sparkling in terms of exciting, but it's critical that you perform well here because it's such a big weighting in the exam. Good luck in your studies.